Good afternoon, ladies and gentlemen, and welcome to the Good Energy Group PLC pre-general meeting presentation and investor Q&A. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll, and if you would give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand over to Rupert Sanderson, CFO, and Nigel Pocklington, CEO from Good Energy. Good afternoon.
Good afternoon. Right, my name is Nigel Pocklington. I am Good Energy's Chief Executive, and I'm joined by Rupert Sanderson to give this short update, who is the company's Chief Financial Officer. And if we go on to the next slide, just to reassure those of you who don't particularly wish to hear a long presentation, we haven't got one for you. I am going to just give you an updated sense for the energy market environment, which is obviously in an unprecedented state of turmoil at the moment. We will then reiterate the rationale for the asset sale that we closed last week, and Rupert will take the shareholders through some of the detail behind that. And then I will pick up the thread really on some revision of our strategy, a kind of refresher on the strategy, and really what we're intending to use some of the proceeds from that asset sale for. And our intention is to allow plenty of time for Q&A, both from the pre-submitted questions and questions that occur during this presentation. So if we go on to the next slide, this is a good way of, I think, giving an update on the energy market. So the graph shows you the cost of electricity and gas for Q1 of this year at those various points in time. So right back from the 1st of July through to the peaks in December and where we are today. So it gives it on a consistent basis. And as you, I'm sure, are already aware, because you will be sensing this as consumers and as people seeing the topic discussed in the media, we have seen very considerable both increase in the overall price and volatility within that market. And so something that would have cost you just shy of £100 per megawatt hour on the 1st of July could cost you at that sort of third week in December point over £450 per megawatt hour. And certainly compared with a year ago, the general price of power is at least 4, if not 5 times higher. So we are living through an unprecedented period of rising wholesale energy prices. Many people who invest in Good Energy are very interested in these matters and won't need too much of a guide from me, but just as a reminder, the main driver of that is a crisis in fossil fuels, particularly the availability of gas as the world economy recovers from COVID, combined with the fact that the UK electricity grid, I should say, is very heavily gas dependent. What we would draw attention in terms of our navigation of this is that 29 energy companies have now gone bust since the start of last year, and I'm happy to say that we aren't one of them, and we continue to trade in a robust fashion and in good financial health. What we've tried to do through our market announcements is to keep shareholders up to date with how we're seeing the market and do so in a fair and balanced way. So in October, for example, we called out the fact that commodity costs were rising, but that we could still see a route to ending the year in touch with the consensus of our likely financial outturn. That remained the case into November. As you can see, actually into November, the prices fell a bit. However, we were forced to issue a warning that our profits at the end of the year would not be near that range of consensus in December, because as you can see, there was a considerable spike in prices in December, and that was combined with the fact that customer behaviour became very unusual through the fourth quarter of last year, and in the end, very few to no customers ended up switching off tariffs or switching providers. So by the time we got into December, whilst we had very prudently forward bought almost all of the winter as it looked at the start of October, we had a higher number of customers and were paying an extremely high price for them, which drove that last update in December. Happily, to some extent, whilst prices remain very high, They did then drop off through the back end of the year, helped by a recovery in wind levels. And almost going live, we're still seeing some of the problems, which is that whilst the overall level of price remains lower, there is still occasional moments of volatility, and the last couple of days are a good example of that. It's cold, it is very still, and at various points during the day, the marginal price of electricity has leapt up over £3,000 per megawatt hour. That doesn't necessarily directly affect us, because by the time we reached that point, we had already secured all of the power we needed to cover our customers' usage, but it's a good illustration of the fact that we are in very difficult and turbulent conditions. So that's an update on the marketplace. If we go to the next slide, one of the things we have recently announced that's caused a lot of interest is then the disposal of our owned generating assets for an equity consideration. So once the debt is paid off or transferred to the new owners, up to £24.5 million. Now I'll let Rupert take over in a minute on the detail of that, but from an overall point of view, I would say 2 or 3 things about this. Firstly, it is first and foremost an asset allocation decision, not wanting to hide behind sort of financial jargon, but we have a considerable amount of equity tied up in these assets, having developed them over the years. But actually, we are very much of the belief as a board that that money would be much better put to use on more of our future-facing strategy, which is something we've been discussing for a couple of years, and something we fought last year's hostile takeover attempt over. And so we've chosen to sell those assets and to reinvest the funds in various parts of our business for the future. It is entirely consistent, second and key message, with our status as the greenest energy retailer in the UK, however, because it was already the case, as Rupert will show you in a minute, that the majority of our power supply came not from those assets, but from our network of independent generators. And in any case, we have retained long-term relationships with the new owners of these assets to take the power at exactly the same price. So it is a transformational transaction for the business that frees up money to invest in our future, and as well as gives us a greater amount of working capital buffer to see our way through the current market turmoil. Rupert, do you want to take us through the detail?
So let me just pick up a few details on the transaction. I think the most important thing in terms of the sort of transformation of sort of financial and capital structure of the business is this now takes us to a substantially debt-free company and has significantly strengthened the cash position as we navigate the very sort of significant turmoil within the sort of wider energy market. And so really sort of significantly strengthened the company's position in that regard. Many of you will know as shareholders that the 47.5 megawatts of power comprised 2 wind farms, about 17.5 megawatts, and 6 solar farms of about 30 megawatts. And we have run a process led by our advisor KPMG, and we outlined that in November in terms of the pace of that transaction that we were looking to execute with a objective of completing in Q1 2022, which we have obviously done. It's structured as a payment received ready of £16.4 million of initial consideration, and up to £8.1 million of deferred consideration, substantially to be concluded within the space of the next 4 to 6 weeks. I think it's important to sort of highlight here the Bluefield structure of this significant upfront payment and a very sort of near-term resolution of those deferred elements. Really sort of stood out in what was a very competitive process for the asset transaction as a whole, and recognised by where the portfolio, which we'd only recently revalued, stood at a net book value of £17.7 million. So we're looking at a transaction here that is a premium to that net book value based on a very recent market revaluation. And as Nigel said, and the graphic at the bottom highlights it. So the yellow bars are the proportion or the volume and proportion of power that we take from our non-owned generation, and the grey stroke black is the volume and proportion of power we take from our own assets, so those 8 assets. And you can see that there's been a sort of very substantial increase over the course of the last sort of 5 to 7 years, and that's really been driven by much more significant volume being bought through independent PPAs, through the independent generators, of which we have nearly 1,900 today. And so the proportion of power that was generated by our own assets had reduced to approximately 15% of our portfolio. But we retain those PPAs, so the existing relationships we have and contracts we have with those assets, we will continue to operate over the life of those PPA terms. So I will now hand back to Nigel to talk about some of the future strategy.
Thank you. And if we move on, just a quick reminder of how we articulate that strategy. So it is, I want to reassure everyone, rooted in being a 100% renewable supplier of 100% supplier, I should say, of renewable electricity. So that does not change despite the change in ownership of these generation assets, which were only a minority of the power we were selling in the first place. And so we remain committed to our position as a very differentiated supplier of electricity to homes and businesses. We also remain committed to 2 other aspects of Good Energy's DNA in many ways. We are one of the leading feed-in tariff providers and administrators, and I intend to invest behind that further and maintain and improve the levels of service we offer to that market. A core part of our mission is to not just generate power, but allow you to generate your own. And we retain that network of 1,900 small generators with whom we have long-standing stable power purchasing arrangements, which covers our consumption of renewable power. So that is a core part of what we do. 2 other areas of real focus. The first is in decentralized energy, so empowering people to generate their own power. And so what we do with that is investing behind new and improved systems for our feed-in tariff customers. We do that by enhancing what we do today. So at the moment we pay a number of our smaller generators on the basis of a deemed payment, which is just a central assumption of what they've generated. We are investing to provide systems to pay them actually on what they have generated, and we're improving the digital interfaces for people to use that more straightforwardly. So a big focus on decentralized energy and a big focus on the electrification of transport, which along with greening the grid and eventually greening heating will be a key part of the UK's journey to net zero. And we do that, yes, through our majority interest in ZAP Map, which is very much the country's leading platform for electric vehicle drivers, but increasingly also by providing products and services aimed at that fast-growing sector of the car market, starting with time-of-use-based tariffs and exploring people using their batteries for home storage and other sorts of areas. So that's the core of our strategy. And if we then move on to focus on some of the areas where we will be spending some, I stress some, of the investment, the money we've just received. Well, the first is bolstering our position in the feed-in tariff market, which may well be familiar to many of the people on the call. But just to remind us, actually the majority of our claims of 250,000 customers are feed-in tariff customers whom we're helping to administer their input of power into the grid as well. Actually, as you can see there, they're very satisfied customers by and large through our measurement of it. Many of them come through recommendation, which is very efficient, obviously, for us. Very few of them, surprisingly perhaps, actually take supply from us, so there is an opportunity there. But nonetheless, we're a major player in this marketplace. And if you click on another slide, Rupert, what we're intending to do, as I mentioned there, is move more of these customers into an easier to use and I think more equitable arrangement, whereby they are being paid for what they generate rather than the deemed amount that Ofgem says they do. So the sort of marketing collateral we're beginning to develop behind this project here is on the screen there, but certainly it will make a lot of difference to somebody who has solar panels but who doesn't consume that much electricity in the home, they will be getting a better offer from us for the surplus they generate, and we'll be able to put that surplus to better use. That's one area we are investing in. The second is then electric vehicles and ZAP Map. So ZAP Map, as I said, very much a leading platform for electric vehicle drivers aimed at reducing range anxiety, which is a big consideration in this, aimed at helping people pay for their electricity more easily, despite the fact that the charge point market is very fragmented, and increasingly newly aimed at helping fleet managers administer their fleets of vans or cars in the way in the old world petrol card or fuel card owners could do it for petrol-driven fleets. So some examples of how ZapMap is going, if we get to the next slide. It's had a very successful year. So if you, in the language of technology businesses, it's certainly shown enough in its developmental phase for us to wish to back their Series A, the money they're raising to try and scale the business. That's what we intend to do in some ways, but here are some headlines. So the thing that stands out, I suspect, is the high market share it has of the total number of electric vehicles on the road. So there are about 400,000 electric cars on the road in the UK, and 320,000 of them are registered users of ZapMap, with a pretty high monthly usage rate as well, so a good measure of engagement. It is by far the most comprehensive service, so you can see that in terms of its coverage of charge points, particularly in terms of live data as to whether they're being used or not, do they work or not, and it has a healthy number of users contributing and building up the platform as well in terms of chat content and routes planned. And so we see a lot from the last year in terms of ZapMap's ability to grow a business, both in terms of subscription content and in terms of people using Zap Pay. We see evidence that players in the electric vehicle market, be they manufacturers or charge point operators, want to pay ZapMap for their data. It's one of the beauties of operating a platform model. You can sell propositions both ways, and we're excited about accelerating the growth of that platform and retaining our majority ownership. So that is the ZapMap story. And then just to round up before we open up for questions, just about on time, the reason to have this meeting today is that about midway through Christmas Eve, Ecotricity, who are a major shareholder in the business, contacted us and requested a general meeting with the two resolutions that you see on the screen. So first, asking for the immediate removal of Will Whitehorn, our chair, and secondly, asking us to stop the asset sale process until we had formal shareholder approval, and questioning the rationale behind that, doing that. On resolution 2, which is a special resolution that would require a 75% majority of the votes cast to pass, in some ways, obviously, that's now a moot point. As we get to the Q&A, I'll be very clear. The board, very well advised by our lawyers, but also in terms of their overall fiduciary duty to do the best by the company and its shareholders. And we were very much within our rights to press ahead with that sale, despite the presence of this resolution from a shareholder who has a track record of disruption. So the sale has happened absolutely within the lines of the Companies Act. The resolution has not been withdrawn, even though it's possibly slightly moot. In terms of Will, our chair, he has a very extensive experience in public and entrepreneurial businesses. He's been vital to the switch in good energy strategy to get behind a more digital and less asset-based approach to the business. He recruited me from the technology sector to come and help lead that. And I think he is an accomplished and experienced chair, and very much to the company's benefit that he chairs our board. And therefore, the board's recommendation, and you can see the full members of the board there, is very much that we recommend that shareholders vote against both of those resolutions. It is a view to date shared by the proxy shareholder bodies, the likes of ISS, who are very positive in terms of our governance and standards, and also in terms of supporting the board in this. And I suppose finally I would note it's a difficult argument for me to take any further, because aside from newspaper articles, we've not particularly seen any detail from Ecotricity as to why they believe otherwise. But I would conclude this formal part of the presentation by reiterating the fact that the board recommends a vote against both of Ecotricity's resolutions. And unlike the takeover process, where supporting the board gave shareholders the easier option of doing nothing, on this one we all votes count. So we do need people who support this position to vote against those resolutions.
That's great,
That's
Nigel.
the end of our formal presentation. I'm going to hand back to you, Mark, to
That's great.
Q&A.
Thank you very much indeed, Rupert and Nigel, for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab that's situated on the right-hand corner of your screen. But just while the company take a few moments to review some of those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard, and we'll notify you by email when they are ready for your review. Rupert and Nigel, as you know, investors had the opportunity to submit questions ahead of today's event, and thank you to everybody that took the time to do so. So perhaps, if I may, I'll start off the questions that we've received, some of those questions that we've received, before addressing some of those live questions. The first one, Nigel, perhaps for you, is: if Good Energy becomes a digital middle person buying green energy from source and selling to customers, is there a risk of those generators selling to the highest bidder or being swayed by a better partner, could be Ecotricity or others, having no actual assets except access to generation market? The same collapses has fallen some of the other companies over the past few months. Does the board consider that it has a mandate to completely change the company's fundamental purpose, having not consulted shareholders?
So there's a lot of themes there, which I'll try and address in turn. So in terms of the board's mandate to do the transaction and whether it's a change in underlying fundamental purpose, I think there are two things to say there. First, it very much isn't a change in the underlying purpose. Our purpose has always been the idea that we would take up the climate change fight by providing and supporting renewable energy and supporting renewable generators. And at the core of Good Energy's purpose, right from Juliet's creation of the business, has been a sense that you don't have to take our power, you can generate your own. And because we retain the commitment to 100% renewable power, and because we are in fact investing behind decentralized generation, I would argue very strongly that actually, whilst the transaction undoubtedly changes the look of the business, it does not change its underlying purpose. In terms of specifically, do we have a mandate to make the transaction without a shareholder vote? We very clearly do, and we run that through both our legal advisors and Investec, our nominated advisor on AIM. And the proportion of the business and the proportion of our assets and our sales and profits that were wrapped up in the generating assets is not high enough for it to require a full shareholder vote. And therefore, we have absolutely complied with our requirement in seeking approval from our board to do it, publishing supporting information around the transaction. So that was the sort of transformational side. Does it place us at greater risk? No. The reason so many energy companies have gone bust, there are two or three reasons for that. They're operating in a world where many of them have to comply with the standard variable tariff price cap, which at the moment is running £500 or £600 at least below the actual cost of what they're supplying. And because of our commitment to renewable, we have a derogation from that cap, so we don't have that fundamental issue of selling below cost. We are obviously dealing with the sort of volatility in the market. That position is not changed by this asset sale because of the reason Rupert said, which is that we retain that very broad network of long-term power purchase agreements anyway, and we still have them with these assets. So our sort of security against the volatility in the market is no different from on the Monday of last week to the Friday after we had announced the sale. And in terms of sort of impact on the wider market, and are we a middleman? To some extent, two things there. One, we always were. So as you saw in that graph, about 85% of our electricity needs were sourced from long-term agreements with independent generators, which is us being a middleman, us offering that platform to generators and to customers. And the way in which we operate, which is through 1 year, 2 year power purchase agreements, is, I think, a benefit for both sides. It helps us understand precisely the cost of our power mix, and it helps generators get a secure and predictable income. And that's how we will retain our operation. If there was a competitive market for renewable generation assets, that is not necessarily a bad thing, because it encourages further investment in those assets. And frankly, you can see that at all scales of the market, from the recent auction of wind licenses in Scotland, which is a multi-million-pound affair. through to people running their own assets and dealing with a company like Good Energy. So I hope that answers all of those questions clearly.
That's great. Thank you so much, Nigel. What I might do, if I may, is combine two questions that we received ahead of today's event. I will read them out in full. What arrangements have been made to ensure that generation capacity equivalent to that which may have been disposed of can be purchased at a price which is no higher than the marginal cost of the disposed generation capacity, followed by kind of, doesn't owning your own assets insulate you from the volatility of the market, and what is the logic for selling them off now?
I think that we've probably covered that a couple of times, but probably just go over it again. The PPAs with those assets we will continue to hold. So we will continue to buy the power from the assets that we have disposed. We have procured power from assets that we've disposed in the past, and we will continue to look to do so when those contracts come to an end, because a PPA contract will typically operate for a period of 1 to 2 years. So as of today, nothing has changed in terms of the overall power that we procure in respect of those assets. I mean, just in terms of the rest of our PPA portfolio, so the 1,900 or so generators, that is the sort of fundamental behind our renewable supply business model. And it's the model that enabled us to secure the derogation from Ofgem's price cap, as Nigel highlighted. It's also the model that supports the highest which eco-provider ratings, and it also allows all of our tariffs to get a gold accreditation on the U-Switch green tariffs. So we're the only supplier who has all of those tariffs accredited to that level. And I think all of that has demonstrated, just thinking back to the chart in terms of the sort of yellow bar and the growth in that independent PPA generation, we've seen that grow strongly over recent years. So we have demonstrated our commitment to support the renewable generation growth from independent providers, but also our success in terms of being able to secure, renew both existing and new PPA arrangements in the market, which has become more competitive over recent years. But we've demonstrated our ability to continue to grow that portfolio. I think in terms of the sort of assets as they stand today, again, I think we've sort of covered off the piece around the sort of hedging. That our greatest security comes from those PPA arrangements and locking in power and locking in prices on a forward basis, as opposed to actually having the power within our own portfolio. It is how we contract, it is how we hedge, and it's our best mechanism of removing ourselves from the volatility. We can't remove ourselves completely from it because renewable generation is uncertain in terms of the amount of power that will turn up on a day-to-day basis, but it's our best way of managing the long-term volatility we see in the power market.
That's great. Thank you. Nigel, perhaps I could pose the next question to your good self. Why do I see no corresponding increase in the tariffs I'm paid for the electricity that I generate?
Well, that depends slightly on the nature of how much generation the questioner does, but large swathes of the sort of domestic generation market, the feed-in tariff and subsequent people who've installed solar on their roofs, the payment is a deemed payment, so there's basically an assumption made by Ofgem as to what you will get. And the reason we're so keen to invest behind that is to pay people on what they supply. And that should result in a general increase in income for people with that arrangement, unless they're very, very heavy users of power.
Thank Thank you very much indeed. Again, if I may, I'll put these two questions together. I mean, they're along the same things. The first one is, I'm disappointed by the proposed sale of the renewable generation capacity. Do not feel that I had this explained to me, and I want to defend good energy from Ecotricity. Going on further, why did the company sell its renewable assets now? What checks and balances were done to make sure maximum shareholder value was generated from these assets to enable it to execute on its new strategy?
Well, first off, thank you very much for the support. I can assure you that we are trying to manage the relationship with Ecotricity in a very professional manner, but do see them as a disruptive influence on our shareholder register, in the board's view, largely because of their status as a competitor, a direct competitor of ours, but I do think it's regrettable. In terms of process and checks and balances and why sell now, so it was a very robust auction process launched in November when we announced our intention to sell them to fund our strategic acceleration. A lot of the detail is bound up in commercial non-disclosure agreements, which is a phrase that sometimes seems a bit sinister, but it has obviously very good commercial reasons why we require people to treat the information we've given in terms of our generation capacity and other aspects of that business as commercially sensitive, and similarly the level of their bids. But I can say that we had a number of non-binding offers over in double figures, so a good number of bidders from both sort of generators and investment firms. And then it was the board's job, and very much part of their fiduciary duty, to review those bids with myself and Rupert and our advisors, and we picked a successful candidate on the combination of quality of their offer and reliability of their bid, and we're very happy with the bidder we picked, partly because we think it's a very commendable deal for the company and one that should produce return, an equity return to us considerably above the net asset value on our books. And we should remember that asset value was quite recent. It was only revalued this time last year. And secondly, because they're very good owners for these kind of assets. They are a firm, a fund very much focused on owning renewable assets. They are a fund to whom we've sold things before. We sold a solar farm to them in 2015, and they have a very good track record as long-term investors in these assets. And in many ways, the solar and wind assets that Good Energy shareholders helped to build in the first place, which should expect a longer life in the hands of their new owners than perhaps they would have had with us maintaining them.
Thank you very much indeed, Nigel. And I think finally, really just to try and find the balance between trying to get some of the live questions as well. One of the pre-submitted questions relates to ZAP Map and how much of the raised funds from the disposal are going into ZAP Map.
Do you want to say that?
Yeah, so ZAP Map is currently undertaking this Series A funding round, and it's Good Energy's intention to participate in that round. The round is likely to be up to £7 million, not necessarily £7 million, but up to £7 million. And again, it's our intention to retain our majority ownership. So that gives us a sort of range of investment, which isn't certainly going to be as high as 7, but could be a proportion of that 7 to enable us to retain that majority position. And we see that as very much the next phase of ZAP's journey in terms of its next phase of commercial and development goals, really building on what Nigel showed you earlier in terms of the stats and the development that it's made over the course of the last 12 months.
That's great. Well, thank you very much indeed. And thank you once again for those that have taken time to pre-submit the questions. And of course, the company review all questions submitted today. And if there are any other responses, we'll make those available. Perhaps if I may, Rupert and Nigel, if I could ask you to open up the Q&A tab, you'll see investor questions have been submitted throughout today's event. If I could ask you please to read out the questions, even who it's from, and where appropriate, give a response, and I'll pick up from you when you're done.
Sure.
Thank you, sir.
We start from the top. So we'll start with Asif, which is what is the reason for completing the deal for the disposal of generation assets prior to the EGM electricity call for shareholders to vote on that. So I hope we've covered that already, but just to reiterate 3 key points. It is absolutely within the company's right to do this. It is consistent with the strategy we've advertised for a while and which we recently got the shareholder support with through the takeover process. And it was a good bid at a good time, which it was in the company's interest to take, both for the certainty of funding, the ability to accelerate our strategy, and also have a plenty of buffer to survive any further shocks in the wholesale market. And secondly, because it was actually one of the strongest bids we received. So from a bidder who also wanted to get on with it. So absolutely the right thing to do for the company overall. We regard the Ecotricity EGM request, general meeting request, as absolutely something they have the right to do as somebody who owns over 5% of the company, but an unnecessary sort of distraction, I suppose, and part of a history of disruptive behaviour by a company who is a competitor of ours. So the second one, how does Good Energy plan to deal with the enormous price rises of energy and the link between renewable energy and fossil fuel prices? It seems to be a strange political and economic arrangement. The price of renewable energy is determined by the price of fossil fuels, especially gas. We're getting this more and more, of course, aren't we, Rupert? Do you want to talk about the system?
It's a very good question, and it is both a strange and political and economic arrangement. I would 100% agree with that. So we are seeing, I mean, on a sort of longer term basis, we have seen over the course of this winter and now into probably the sort of summer and following winter, we have seen the sort of wholesale price being driven quite substantially by gas, and so all of the indicators around gas demand, which have obviously recovered very strongly post-COVID. We've seen particularly sort of cold periods in Asia, and we are a significant proportion of our gas comes from liquid natural gas, LNG. I've just abbreviated it LNG, it's easier. Where effectively the tankers can turn left or right to Asia or Europe. And so there's a substantial amount of geopolitical and worldwide demand for gas, which is driving prices in Europe and the UK. And that's on a sort of longer term basis. On a real short term basis, each half hour of each day is a separate settlement for the power that goes into the system. And it is effectively settled at the highest marginal cost that a generator is asked to provide into the system for. So we're seeing at periods of very low wind in particular, or when there are nuclear outages, that very expensive coal, oil, or gas peaking plants are being called upon to provide energy into the system. And as Nigel said, those prices at times are still and cold. Yesterday there was sort of £3,000 to £4,000 a megawatt hour, which is 100 times where you would normally expect a power price to be. And so there's a very sort of strange situation whereby that is driving the price of renewable power in the same way as any other power on a half-hourly basis, because that is the price that the system determines that each generator should have to pay. So there is a sort of significant challenge and a significant push to try and decouple some of those linkages between the fossil fuel price and the renewable price, and really building out more renewables and increasing the amount of capacity that the renewable generation can support is our best way to support that in the long term.
Thank you, Rupert, who, as you can see, is the executive responsible for dealing with this market on a daily basis. I just wanted to reiterate this odd message that yes, by being a customer or investor in Good Energy, we're absolutely supporting renewable generators because we source back all of the power we use over the year to renewables. However, we, like absolutely every other player in the marketplace, are operating in one system with one system price, governed by fossil fuels, which is why we're not immune from those price rises. So there's a question from Francesca here, which is Ecotricity owns 25% of the company's shares, which they do, and this is not the first time they bring a shareholder to adjudicate on its script with the board. Why do they own these shares? If they're so unhappy, why can't they just sell them? They would make a nice profit. So I can't really comment too much on Ecotricity's motivation for holding shares in Good Energy. We've been clear in our communications that we obviously respect their rights as a shareholder and obligations to them. However, their track record has been disruptive. They're a direct competitor. They obviously intended to buy the company last year for a price and a plan, which we as a board and the shareholders who supported this did not think fit. And you're certainly right to see that nobody is forcing them to hold these shares, and it doesn't seem a very sensible thing to do to hold them and then constantly criticise or cause disruption. But we obviously respectful of their rights as a shareholder, and it'll be interesting to see what they want to do next.
So the next question is from Manor. Even though we've moved past the peak price of power and gas, do you think we should still be careful about any other market shocks? Which is again a good question. I mean, the first thing to say is we don't know that we've necessarily moved past the peak of power and gas prices. We've moved past and come off the peak that we saw in late December. But I don't think we should necessarily think that there are no other shocks in front of us. And therefore, absolutely, we will continue to be careful. And one of the things that we have obviously identified is that the market is still uncertain, and so the proceeds we have from the asset sale, we will be cautious in terms of how we will deploy those in the short term. We've obviously identified a near-term need for investment into ZapMap, but that is only a relatively small proportion, or certainly a minority proportion of the funds that we have received, the funds we will receive. So we will very much so consider the need for working capital buffer and the sort of future needs of that supply business in a market which is more volatile than we've seen it in recent years, certainly as we go through 2022.
Thank you, Rupert. So here's Mike. Do we anticipate reintroducing domestic heat pump and EV tariffs? So that's a good question, and one I can give a simple answer to. The answer to that is yes. We withdrew some specialist tariffs from the marketplace in the peak of the market uncertainty because what you need to be very careful of is committing to quite heavy amounts of supply at different times of the day without necessarily having covered the sort of position 12 months up front. So it's a very cautious stance to say, stop selling those for now. As soon as we're comfortable that we've got a bit more stability and we're obviously now comfortable with our working capital funding, those are sort of the areas we would anticipate moving back into very quickly. So here's John. Could you start to talk to stress energy as a service? The sky-high energy prices we're now facing is surely going to rapidly accelerate the need for this. Yes, I couldn't agree more. So energy as a service is really a way of saying, we exist to help people generate their own energy, or at least understand their energy consumption and do so more efficiently. And we invest behind those propositions. So hence doubling down behind Feedin, tariff and its successor schemes, because I suspect that both the energy crisis and the fact that the cost of owning and installing solar panels has reduced considerably in the last couple of years will likely very much increase demand for that. We can see some early signs of that in our partnership with Capital, who are one of the main installers of this technology. So that plus, don't regard this as a utility, regard it as something to be consumed with sort of interest and a smarter and more flexible approach, we think are very much core to the investments we've already made in things like Kraken, our customer management service, and our future plans. So here's Graham. What's the broad timescale for the move from deemed export to actual export? Both as customer small generosity, we get the worst of both worlds at the moment with very high tariffs. And if you just scroll down a little bit, Rupert. These are paid to a generous price, but you're not getting as much. So that's a good question, and I anticipate this project and program is ongoing for us now. There's some early improvements to our Feedin tariff experience due to go out more around supporting administration and meter reading, and certainly by the end of this year, I would expect to be offering proper sort of export tariffs as opposed to deemed tariffs. you want to take from fixed to variable? It's probably worth it.
Matters. Have you observed losses due to larger amount of switches into fixed tariff and need to procure power at extremely high price? If so, how many clients switched and what was the loss? So one of the things that I'll answer. I think I understand the broad thrust of the question. So one of the things we talked about at the back end of last year was that the sort of market stasis, so the sort of complete freezing of switching in the domestic marketplace and so the U switches and the money supermarkets became effectively unfulfillable channels over Q4 and substantially remain so today. A similar thing happened in the business environment as well. So customers who were coming to their end of the contract found they were no longer able to move on to either another contract with another company when they wanted to perhaps leave. So we did see the impact of a higher number of customers actually who we weren't necessarily putting onto a fixed tariff, but they were moving on to a sort of default or a SVT product at that point in time. And we weren't necessarily expecting to have those customers. And not having those customers at a time when the market price was very, very high was something we called out as an impact on our business at the back end of last year. So it has been an impact. As Nigel said earlier, we are in a position where we have a little bit more pricing flexibility than a number of companies, particularly in the domestic marketplace. So we've been able to adjust our tariffs to both a combination of the number of customers we have on our domestic products and the prices that we're seeing in the market to supply that extra power and gas that we see from them. I hope that answers the question.
Thank you. Can you share any remarks and any dissenting views expressed by members of the board re Resolution 2, which is the resolution around shareholder approval and stopping the asset sale until it's acquired? Obviously, overall board discussions are confidential, but on this matter, I can absolutely speak for the whole board, which we are the two executive members, that the board is very much in agreement with the fact that this was a transformational deal for the company and great timing, and therefore wanted to approve it. And we obviously sought advice from Norton Rose, our principal legal advisors, and indeed they from counsel, just to be double sure that we had the right to do this deal, despite the request of the EGM, and took a lot of comfort from the fact that the advice was very clear that we did, and it's consistent with the board acting in the taking its fiduciary duties and acting in the interest of all shareholders. I've heard about Ecotricity's resolutions from your emails, but I haven't yet had the information directly, and I don't know the text of the resolutions. Why haven't they been sent to me? And how can I get to see them? And finally, can you remind me how long Will Whitehouse been with Good Energy, please? So, on the mechanics of this, yes, you have seen our shareholder circular, either by email or post, depending on your preferences. And somewhere the text of the resolutions is in that. The important thing about, by the way, about that being a circular is that rather like our work during the takeover defence, it is all thoroughly verified with our legal advisors, and we can refer back to the sources and bases in the technical terms of all the arguments we're making. So it's kind of a lot of care goes into that official channel of communications, because we're very respectful of the fact that this is your money as shareholders, and you need to make investment decisions based on clear and verifiable information. So you should be able to find the text of those resolutions in that circular. Ecotricity haven't yet, but still have the right to send up to 1,000 words to our shareholder base, informing them of the resolutions and what their rationale is. And if should they choose to do so, we will have a right of reply, which we will take up. But until they do so, I'm afraid I can't give you any more detail. A question on smart meters. And the degrees of smartness of them. So I'll take this one, and then maybe you can do the shareholder question and the ethical principles we can do. So just on smart meters, I think SMETS 1, which is the first phase of smart meter rollout, gets an amount of fairly justifiable criticism, frankly. As a platform, they have been too inflexible, pretty inflexible when a customer switched energy provider, and don't necessarily offer the best service in terms of being able to engage with sort of some of the newer propositions that we're talking about. The SMETS2 meters, which are the ones that are being installed now, are that much more flexible in terms of switching provider, communicating back, enabling things like time of use tariffs. There's a lot of effort to try and upgrade some of that SMETS1 fleet where they can be to enable this. But I think the key question to ask in these is always, is it an early generation or is it a more recent one, which I think are genuinely, for all the mixed press they get, the best way a domestic consumer can engage with energy as a service and take up some of the propositions we've been talking around incentives for smarter energy use. Institutional shareholders, do you want to say that?
Yeah, so question from Nick, do you have any institutional shareholders? Yes, we do. The only ones that will be disclosed in our annual report will be those that hold any more than 3% of share capital, and that's a relatively small number. The majority of our shareholding is with retail shareholding, so we're probably relatively unusual as a listed business in that a minority of our shares are held by institutional shareholders. A quarter of our shares are obviously held by a private company, Ecotricity, but the majority are held by retail. So I hope that gives you a little bit of a breakdown of who's in our shareholder base.
Thank you. And a question from Florence, which I've also seen in various other pre-submissions, which is, how did the buyer get vetted for ethical principles and commitment to operating and maintaining renewable generation assets? Well, as I said, it was a competitive process, and not just price and speed, but also the nature of the would-be buyer was taken into consideration. And Bluefield, I think, passed all of those checks thoroughly. They are an investment fund and a public company, so they have considerable standards of governance and disclosure. The investors they attract tend to be pension funds who are looking for pretty sort of reliable yield on the investment. And they are very major players in onshore renewables, frankly, much bigger than we could ever be. They've already bought assets from us in the past. They bought Wraithorn Farm, I think the facility was called in 2015. And we're adding to a significant portfolio they have, which was initially probably more biased towards solar than anything else, but they have some experience in wind as well. So it's gone to a 100% renewable generation focused business who are, I think, very good stewards of these assets and delighted to take them on. And John, where do we see revenue growth coming from the company in the future? If you exclude the current situation, yes, there's a sort of with regret side of that, which is that with the price of electricity going so much higher, revenue growth will follow it. Certainly also does cost growth. We're trying, I suppose, now that we have sold the assets, to position ourselves as much more of a growth-focused business. So, point one, we have very negligible debt now, so there is less of a sense that our interest payments and the rights of our debt holder will kind of trump other investment ideas, which I think is helpful background. But we see significant growth potential in our electric vehicle play, not just through the business ZapMap is growing, but through products and services for electric vehicle owners. As a reminder, electric vehicles are by far the fastest growing category in UK car ownership. Month on month now, you see evidence of significant sort of double-digit percentages annual increases in EV ownership. So we think there is a strong underlying growth driver in terms of electric vehicle ownership. We think there's a second strong underlying growth driver in the increased level of commitment to and understanding of sustainability and the real nature of green power. And until the energy crisis became the top story, we were making very significant headway with our campaign about greenwashing and the fact that many tariffs called green were nothing of the sort. They were just backed by renewable certificates. Once the market starts moving again in terms of customers switching, we're also going to see a very interesting environment where there are no longer 40 to 50 energy companies competing to be the cheapest and calling themselves green when they weren't. There are likely to be a number in the teens with slightly more distinctive propositions, and it's going to be much easier for us to stand out because of our commitment to renewables. So I suspect there is good underlying growth to go there. And we know that there is increasing levels of consumer interest in and business interest in supporting sustainable generation. I suppose the last area we're expecting further growth is because of the fact that decentralised generation is becoming cheaper and more reasonable, and because of a new wave of investment into new consumer technologies in this area, we can see considerable growth in that market as well. So those will be the main drivers of growth for Good Energy.
Rupert, Nigel, I might just jump in if I may, just as we're coming up to time. And thank you once again to everybody who has submitted questions this afternoon. And of course, the company will review all questions submitted today, and any additional published responses will be made available to you on the Investor Meet Company dashboard. Nigel, Rupert, I know investor feedback is particularly important to the company, and I will shortly redirect investors to provide you with their thoughts and expectations. But perhaps before doing so, if I may, if I could ask you for a few closing comments.
Well, thank you very much for making the time to hear the presentation and Q&A session. And I think I just really want to reiterate the key messages we've got across. We see this deal as transformational for the company's ability to invest behind future-facing propositions. But we don't see it as transforming our commitment to renewable generators around the country and our commitments to the role that moving to a much more renewable power grid can play in achieving the UK's climate goals. And so, we're very pleased to have done the transaction. We think it is a transaction for a good price at a good speed that gives us certainty to invest behind this strategy, but also keeps us in a strong and prudent position as we navigate the crisis that the energy market is going through. It is a source of some regret, frankly, that Ecotricity have chosen to move these motions, and I, at the moment, can't give you much more in the way of explanation as to their rationale, but I wanted to reiterate the board's unanimous and very clear recommendation that we are asking shareholders to actively vote against both resolutions and allow us to get on with the job of running one of the UK's most innovative energy companies, and a company that I think can play a real role in meeting the UK's aims in terms of getting towards net zero.
That's great, Rupert. Nigel, thank you once again for your time this afternoon and for updating investors. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Good Energy Group PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, and good afternoon to you all.